you're a dividend investor or you're considering starting a portfolio with dividend-paying stocks, there are a lot of mistakes that I see new investors making. In fact, this video right here is the video I wish I saw when I first got started out, because I made a few of these mistakes and I wish I had something to guide me. So my hope is, now that I'm creating this video for my past self, that it helps you in avoiding some of these mistakes when you get started with your investments. Dividend investing mistake number 1, not considering the payout ratio. A payout ratio for dividends allows investors to evaluate the sustainability of that dividend being paid out long term. But we want to make sure that that payout ratio isn't sketchy. So here's what I recommend that you do. Go over to a site like Seeking Alpha. Then what you want to do is type in your favorite dividend stock or ETF, click on it, and then hop over to the dividends tab. At that point, scroll down to where the dividend summary is and look at the payout ratio. If you see something that is abnormally high, that's something that you want to keep your eye on. A lower dividend payout ratio, what that means is the company is retaining a larger portion of its earnings for reinvestment in the business. Also, a higher dividend payout ratio could indicate financial stress or the fact that they're just trying to attract new investors, but they don't have all that money there to sustain it, which means you could see a dividend cut in the future. Now, if you see a payout ratio above 100%, that's a big red flag, because what that could mean is not only are they paying out 100% of their earnings back to the investors in the form of a dividend, they're also paying above their earnings, which means they're tapping into their cash reserves, their balance sheet, in order to make that dividend. Now, the only exception to high payout dividend ratios is those of MLPs or REITs, real estate investment trusts. There's actually a law within the IRS that says that you must pay out a minimum of 90% of all your earnings if you're this kind of dividend-paying stock or company. Dividend investing mistake number 2, not considering the yield trap. So a lot of stocks may seem very exciting because they pay a high dividend percentage. Let's say it's like, oh my gosh, that's like a 10% dividend yield or a 15% dividend yield. You got to make sure you do a little bit of additional research. It's easy just to say, oh my gosh, if I buy this many shares, I'm going to make this much money every month or every 3 months in the form of a dividend. Why wouldn't I do that? But that's where you get trapped with the dividend yield trap. So you can avoid this mistake by looking into the financial tab to look at the balance sheet, the income statement, and the cash flow of the company. Over at Seeking Alpha, I type in whatever stock or company I'm looking at, click on the financials tab, and then you'll have access to all 3. Here's some of the things that I'm looking for. Number 1, I'm looking for revenue growth consistently growing each year. You want to see as the years go on that they're doing activities that help continue to grow the money that's flowing into that company. Number 2, I'm looking for both net and operating income to be on the growth as well. Sure, you could have your revenues going up, but if you're spending a lot of money out, is your net income still as strong? Number 3, I want to make sure their assets are more than their liabilities, which means that they have more money on the books than they do debt. And number 4, I look for positive free cash flow consistently. So let's talk about a yield trap and some examples. So here are a few examples of companies that have fallen under the category of a yield trap in the past, and some of them are quite famous. Starting right off with General Electric, ticker symbol GE. In 2017, GE's dividend yield was over 4%. But due to a combination of financial struggles and a restructuring plan, GE ended up slashing its dividend by 50% in November of 2017 to only 1 cent per share in 2018. That is terrible. And if you're a dividend investor and you were like all in on GE, that would have hurt to get basically a pay cut of 50% as a result of that. Second example is Lumen Technology, formerly known as CenturyLink. So in 2018, CenturyLink had a dividend yield of 14%. How exciting does that sound? But unfortunately, they were overloaded with debt. And in order to get past that debt load, in February of 2019, they slashed their dividend by 54% to help reduce leverage and improve its financial position. Last example is Budweiser, Anheuser-Busch InBev. In 2018, they had a dividend yield of over 6%. However, the company was burdened in a significant amount of debt after they acquired SABMiller. You know, the famous Miller beer? It's actually now under Anheuser-Busch. And as a result, it had to cut its dividend by 50% in October of 2018. Do you have other examples of companies that were at yield trap or had to cut their dividend yield? Drop a comment down below and let's have a conversation about it. But that's why it's so important to keep your eye on your individual companies that you're an owner of, that you buy into, that you invest in. Because of things like this. If you see that financial sheet is starting to look bad and maybe it's popping up some red flags, it's time to do some additional research to make sure you're not getting caught with a dividend yield trap. Dividend investing mistake number 3, not considering tax. Well, Uncle Sam and the United States, they want their money. He's a ruthless guy who will not take no for an answer. And so tax implications on dividends can vary greatly, depending on the type of dividend that's paid, depending on your particular income, depending on your filing status. There's a lot of different things, and it also depends on what country you live in. Now, for the United States, there's two different classifications. You've got a qualified dividend and a non-qualified, otherwise known as an ordinary dividend. And both of these categorizations can cost you a lot of money in tax. So let's dig into it, because this is a very big mistake that people make. We're going to talk about qualified dividends. Now, qualified dividends are paid by a U.S. corporation, of course, in the form of a dividend, but there's a holding period requirement. So there's something called an ex-dividend date. And an ex-dividend date means that you are a shareholder by this particular date that we say you need to be. And if you are, we're going to pay you a dividend in that particular month, quarter, or year. But you got to be a shareholder on the ex-dividend date. But in order for it to be qualified as a qualified dividend and save you on tax, you need to make sure you hold the stock for more than 60 days during the 121-day period that begins 60 days after that ex-dividend date.
Hold on. What? If that didn't make sense to you, it sure didn't make sense to me either. So let's do a hot tip on this whole thing Bob just mentioned. Let's say here on our calendar, April 1st is the ex-dividend date of a stock. What we want to do in order to get the tax benefit on a qualified dividend is to ensure we bought the stock 60 days prior to the ex-dividend date. In this example, it would be on February 1st. Then, we hold the stock for a minimum of 61 days after the ex-dividend date on April 1st, which would put us into June. The key here, though, is to always consider buying and holding, so you'll have a better chance of taking advantage of the potential tax benefits without worrying about all of these dates. But it's wise to check with your tax professional if you have questions. Okay, back to Bob.
Qualified dividends are taxed at a lower rate. Tax rates can be 0%, 15%, or 20%, depending on your tax filing status and your overall taxable income. So when you go to buy a dividend stock, make sure you focus on the ex-dividend date and make sure you're not just going in and going out quickly just to take advantage of a dividend and then sell and run away with the dividend. You can do that, but just keep in mind, you're going to have to pay additional tax. It would not be a qualified dividend, and therefore, the taxes are different. Let's talk about that. It's called a non-qualified dividend, otherwise known as an ordinary dividend. So they don't meet that criteria that I just mentioned. This could also be certain companies such as the Real Estate Investment Trust or other things like that that aren't classified as a qualified dividend. So that tax rate is a lot more, anywhere from 10 to 37% or whatever the current tax rate is for your ordinary income. What a big difference, especially if you have a big portfolio. And let's say you're a day trader and you start going in and out on the ex-dividend date, and all of a sudden you're getting this sudden flux of cash. Wow, that could be a ton of tax that you have to pay unnecessarily than if you would have just held on for that 60-day and the 121-day period after the ex-dividend date. There's another very important thing to think about, and that is the way that you do your dividend investments. Do you have it in a taxable account or a non-taxable account? See, a non-taxable account could be like an IRA, Roth IRA, 401k, something like that. A taxable account is just your normal everyday investment brokerage account. The thing with an individual retirement account is that it's sheltered from the tax. You can get all the dividends, you can sell, you can buy. It's all sheltered within that account as long as you keep it in that account for the life of it until it's time for retirement. And the best thing about a Roth IRA is you never have to pay taxes on it now or forevermore, because you pay taxes on it before you initially deposit money into the Roth IRA for investing. So if you have it sheltered in a tax-advantaged account, that's the best place to put dividends. If not, you got to make sure you're keeping an eye on qualified versus unqualified dividends. Dividend investing mistake number 4, not considering aristocrats or kings. Now, there's a lot of companies that have been around. They have a great balance sheet, they have great financials, and they've been playing the dividend game correctly. See, a dividend aristocrat are companies that have consistently increased their dividend for the last 25 years, consecutively, every year for the last 25 years. This is the sign of a strong and long-term company. So 25 years of growth means that they continue to grow their revenue, they continue to grow their earnings, because without that, they wouldn't be able to continue to grow their amount paid out in the form of dividends every single year. So some of the examples of some dividend aristocrats are on the screen right now that you can do a little bit more research on after you watch this video. And then you have a dividend king. Now, the cool thing about a dividend king is we're talking about at least 50 years of consecutive dividend growth. Examples of some dividend kings are listed on the screen. Dividend investing mistake number 4A. Not subscribing for more dividends and personal finance content. I'm only just joking, but if you're finding value, stick around for a little bit. Hit the subscribe button. Let's move on to dividend investing mistake number 5, not considering DRIP. Now, a lot of dividend investors are going to understand this, but if you're newer to the game, DRIP stands for Dividend Reinvestment Plan. And what that does is it allows investors to reinvest the dividends back into the same company stock without brokerage fees or some of the additional fees that often come with investing. This can be a significant way to grow your wealth. See, you can easily take your dividends and cash them out and go get a beer or something like that, but then you're not actually taking advantage of some massive wealth growth. I mean, we're talking about this $5 could turn into like thousands of dollars with the dividend reinvestment plan. But let me show you an example of why this is so powerful using ticker symbol ABBV. This is a very popular dividend paying stock. So you can see right here in the charting on Seeking Alpha, we have ABBV at 101%, and that is called a price return over the last 3 years, indicated by the orange line. You can see right now it's actually outperforming the S&P 500, which is kind of cool over the last 3 years. But look at the difference between price return, remember this 101%, keep that in your mind, and then when I come here to total return, now total return considers all the dividends paid. I click on that, now look at the difference. We're talking about 130%, a 30% difference based on investing those dividends. And remember, when you invest dividends back into the company, you get a fraction of that share back. So let's say you only own 1 share and you get a dividend, you may now own 1.2 shares or whatever that dividend payout was. And as you continue to grow, your money earns money on money. This is the true effect of compound interest and why dividend DRIP is so important. Dividend investing mistake number 6, not considering growth versus yield. So you have a choice as a dividend investor, and you could do both, but the really big choice here is, do you go after companies that are dividend growth companies, or do you go after companies that are high dividend yield paying companies? So each of these approaches do have pros and cons, but understanding these differences can help you when making the best decision for your dividend portfolio. Let's talk about the dividend growth stocks first. So if you're going after dividend growth stocks are companies that are consistently increasing their dividend payments over time. They have strong financial health and a history of earnings growth. Growth stocks typically have lower yields but can have potential of future dividend increases, which also results in a higher yield on cost over time. Dividend growth stocks can also provide a hedge against inflation, which right now, inflation is a lot higher than it used to be. So by increasing dividend payouts on a dividend growth stock, a lot of the investors get that opportunity to hedge against inflation and keep their purchasing power. Now let's talk about the high yield stocks that you might go after. Now, first of all, high yield stocks are companies that offer high yields compared to the market average or other dividend paying stocks. These companies may be mature, slow growing, or operate in sectors with high dividend payouts, such as utilities or real estate investment trust or something like that. High-yield stocks can provide immediate income for investors, which can be attractive to those who are seeking income generation in the short term, such as retirees or people that are no longer getting income from a day job. But you got to be careful. And you got to be careful because a high dividend yield does not mean that everything's great. It could actually mean financial distress or potential cuts, as we discussed in mistake number 2, which is why it's critical to do your research if you're investing in single stocks. Now, that choice between growth and high yield leads us to mistake number 7, and that's not understanding your stage of life. Dividend investing strategies can vary based on your age, risk tolerance, and financial goals. See, it's easy to just watch a YouTube video and invest because you like the YouTuber and think they're cool. I mean, But seriously, take a step back, look at your own personal finance goals, as they might not actually line up with that YouTuber. That YouTuber may have a whole different financial plan. They may have different income. There's a lot of different things that you need to consider. So focus on number 1, you. And there's 4 different stages that I see, and you got to think about what stage are you in, what stage are you approaching, and how do you best handle your money when it comes down to dividend investing. Number 1 is early career and wealth accumulation. So this is where you take a little bit more risk. Maybe you're going in on some of those crazy stocks, a lot of volatility, maybe a high yield, maybe a low yield, but it has a lot of growth potential. Maybe it doesn't even pay a dividend yet, something like a Google or a Tesla, and you're just trying to load up some wealth, let that price return go up, cash it out, and then do something with it later. but you have time on your hands. So even if the company doesn't do well, you have enough time to recover so that you can still be a millionaire in your older age. If the company does really good, you're chilling like a villain. You have time on your hands. That's the point of wealth accumulation. Number 2 is mid-career. Now, this is where you're starting to transition from that aggressiveness to maybe a more moderate portfolio. You don't want to like totally YOLO because, you're middle age. You want to make sure you're doing the right thing and everything's fine. But you also want to focus on that preservation of capital, and maybe you're going to start moving a little bit more into those dividends and more of the dividend growth companies. Number 3 is pre-retirement and income generation. Now, this is where you're really going to start shifting over into dividend-paying stocks. This is where maybe you're looking at higher yield companies, very successful REITs, things like that, which leads you into that final retirement stage. And this is when you're retired and you don't want to like hope that the stock market goes up or down. You kind of want everything to be stable because you've spent your life building this amazing portfolio. Last thing you need is a stock market crash, right? That's the last thing we need at all. So what you want is income to kind of replace that 9-to-5 job. But you need a high yield, yet a very stable financial company to invest your money in. So you can get that consistent dividend without worrying about dividend cuts or worrying about a crash of that particular stock or ETF. But you might wonder, okay, but I'm not into the whole individual stock thing because that's a lot of risk. You might want to actually consider ETFs because ETFs allow you to diversify right away. They'll hold a lot of the different companies within one ETF. And then if one company fails, it's all good because you're protected by the other companies that are within that ETF. So to learn about some really cool ETFs that can make you rich, check out this video right here, and we'll see you on the next video.